It's been a few days since we last recorded a video, and here we are. We've seen a number of earnings and they're pouring in. The title of this video, it's all pouring in, earnings are pouring in, etc., etc., etc. What is our take? What do we do with this information? Should we be trading it? Yada, yada, yada. What's our current positioning? So we're gonna go over all of this. In the past couple of days, our fund has added shorts. We've added shorts via options. We've added shorts via stock. We've just gotten slightly more incremental in that direction. And we're ready to evaluate here in this video the bigger picture with regards to the market, given the information we've seen. Clearly, the heavyweights of the world are now beginning to take a little bit of a hit. And this was not much of a surprise to us. We've been talking about that on this channel for some time. But now it's coming to fruition, and there's a reason why we haven't really wanted to own these mega cap tech companies. We own Meta and Amazon, going into CPI for maybe 2 or 3 days, just quickly in and out. That was our first time owning Amazon. We were out, and this is just the nature of it. These stocks were benefiting from a very stimulative environment. They were viewed as safe havens. If you remember the late last year, early this year videos, a big part of our thesis was that mega cap tech companies were going to get hit because yields were going to rise. U.S. Treasuries were going to become safe haven assets again, and we're going to actually offer a legitimate return, which they weren't doing previously. And just by the very nature alone of that, if the mega cap techs were doing everything they needed to do, the stocks would just slowly deflate because the capital would go from the previous safe havens back to the normal old risk-free return safe havens that is the US bond market. That has happened, but now we're seeing fundamental declines in the business, although temporarily, possibly temporarily, with regards to earnings. And therefore, you have to recompress multiples. You have to bring down that price once that earnings slides. Now, I get Apple is yet to show that. We'll see. We're seeing some signs of weakness in various areas of the market. I'm going to listen to that earnings call later today. We'll see what other products are. Are these Apple Watches? Could be, for sure. Are these speakers? AirPods? Definitely could be. Who knows what they're going to surprise us with. I mean, it's Apple, very solid, very legitimate business. They're not going away. I'm not saying any of these mega cap companies are going away, although Meta might. I'm just saying that they were in a Goldilocks environment. They received Goldilocks benefits from pension funds, et cetera, et cetera, et cetera. And now that is going to begin to diversify away from just a select few mega cap companies, 5 of which occupy 20% of the S&P 500, or did. And now people are hopefully going to be more comfortable owning something like Cleveland Cliffs, which just prints cash. And those companies might occupy more of a portion of the S&P 500. Let's not forget, if you go to this channel, we've had the same pinned video for roughly a year now. It kind of talks about everything we've said thus far and have now seen play out in reality. So if you've benefited from that, I encourage you to stick with us as we navigate these interesting of times in the American equity markets. So what are we doing here? Well, we're cautious because this is a very interesting environment here. We have to be humble and recognize that and not think we are some sort of ultra market wizard, although we do our best to be a market wizard. So we've got reasonably high cash levels, roughly 30%. We've got roughly 30% in energy stocks. And then we've got roughly 30%, a mix of shorts, some, really speculative, really cheap plays like Jumia. We've got Disney. We've got call options sold against our Disney. These kinds of things, just 30%, well-calculated bets, 30% energy, 30% cash, a third, we'll call it that. And that's how we're positioned. We're just kind of seeing how things go. We were cautious around Apple. We're cautious around the rest of the market. We're short Apple. We're short the market, but we're not all in on either of those bets. We're bullish on energy. We're not all in on that. And we're not so afraid and so bullish on the US dollar that we're all in on that. We're properly diversifying around cash-based businesses, and in that 30% with the shorts, with the Jumia, we'll include things like Cleveland Cliffs, which we mentioned earlier in this video. That is a portion of that. So, acknowledging the state of the economy is weakening, but also acknowledging that some prices are down and some areas of the market have been mispriced because of the mega cap techs and might benefit from a little bit more rationalization of valuations, while at the same time, again, being cautious around rates possibly going higher and the economy possibly weakening. It's just starting. The effects of rates we might just be seeing. I mean, we're seeing it in the advertising market, probably the first area of the market to be hit. So expect Q4 to be a little weaker. Rates going to remain high Q4 this year to Q4 next year at minimum. So expect this to slowly build on itself a little bit. I'm not saying it's going to be catastrophic, but it could get pretty not ideal. It's going to probably be a recession. I get it, this quarter GDP positive, so interesting, but not the best environment. Not the best environment. So that's today's video. Feel free to ask questions, leave comments down below. We're going to listen to that Apple earnings call. If anything crazy comes up, we'll let you know. That's today's video. And until next time, peace out.